Hello and welcome to another Smaulgld live stream. Today is Monday, September 10th, 2018, and tonight's topic is what drives the prices of gold and silver. And we're not going to get an answer to that, but we're going to show, I think, that there's some differences between what drives the prices of gold and silver. They do not have the same inputs that necessarily drive either of them at the same time. I would conclude that gold in some respects drives the price of silver, meaning the price of gold drives the price of silver. But again, there's not a clear correlation there either. As we're going to see, we've got a number of charts to show you tonight to discuss and get your comments on. And I think it'll be very interesting for you, make you think about the relationships between gold and silver. Let's take a look at gold and silver. Down, but not down by much. Silver down 2 cents today. Opened at about 14.10. Actually went up a few cents. It went up to 14.14, and that's where it is. It had gone as high as 14.23, but came back down. I guess let's see, gold, same thing. Gold opened at 11.94, 11.93, closed at 11.94. All right, in the cryptocurrencies, they're pretty much holding steady. A little bit on the uptick on Bitcoin, 63.02. It's up almost 1%. Bitcoin Cash down about 4% to 466. Ethereum still under $200 at 197, down about 1%. And Litecoin down about 1.5% at 54.30. Okay, let's take a look now at the differences in what drives the prices of gold and silver. There's been a lot of talk about the gold-silver ratio unsustainable, as if the two of them are nearly identical metals and therefore are supposed to trade on the basis of the relative rarity, the relative availability above ground, below ground, all these ratios which really have nothing to do with each other, because gold and silver are distinctly different metals. We had done a blog post and a YouTube, 12 differences between gold and silver. There's plenty of differences. We're not going to go through them all, but just off the top of my head, gold is still a monetary metal. It is used by central banks as an asset, as reserves. Silver is not. Silver historically has not been as prized. It's been pocket changed. There's no gold standard. There's not a silver standard. There's a gold standard. There's many differences between the two metals. They do share a monetary history, but they are not the same metal. And even when they shared a monetary history, and even when the ratio was 16:1 in history hundreds of years ago, it was generally because it was set that way just as a matter of convenience by the people doing the monetary policy. It wasn't necessarily market-driven that the ratio was 16:1. Gold and silver have distinctly different monetary functions today and even back when. Gold was a central bank tool during the Bretton Woods Agreement from 1944 to 1971. From 1944 to 1965 in America, there was no gold. You weren't allowed to own it, but silver circulated freely as coins. So you can see the different type of monetary metals, and then silver has a different industrial profile. It's been changing over the years. It used to be for photography. Now it's for electronics and solar. Gold has always had a minor industrial use. It's just generally too expensive, but it used to be used in teeth. So they're different metals. It's very almost, it's not idiotic and it's not moronic, but it's almost naive to just look at them as if, well, one is rarer than the other by a certain percentage, so that's what the price should be. And the market disagrees. I mean, over the last 100 years, you're looking at a chart that shows that the gold-silver ratio, you can't see the bottom there, but those lines at the bottom where you got the right Pittman Act, inflation, Hunts Brothers, that's when for a couple of months the gold-silver ratio actually got down to that level, the 16:1. But you can see over the last 100 years, it's been nowhere near 16:1 for most of the time. The average has been in the 60s, if you look at it. So, and that highlights that gold and silver are different. It's not just about the ratio of how many ounces there are of gold versus how many ounces there are versus silver. Two quick examples I always give is my artwork is far more rare than Picasso's, yet his goes for a higher price. And the other one is platinum. Platinum is pulled out of the ground at just 1/10 of the amount that gold is. And yet, gold is more expensive than platinum. You could say, well, platinum's not monetary, but gold is. That's somewhat true, but also, how monetary is silver right now? It really isn't. Also, copper is a monetary metal. Do we do a copper-silver ratio? Do we determine copper's undervalued? Copper's useful? So the idea that somehow that the gold-silver ratio has to be based on relative rarity, to me, is a non-starter. It may be indicative of something, but it's certainly not the way you would value things all the time. You just have to look at the two of them and say, well, one is more rare than the other, or there's a percentage rarity, and therefore that's what the price should be. But that's not what we're here to talk about. We're here to talk about not the differences in the uses of the gold and the silver and their properties and histories, but more, how does the market value gold and silver? And I would argue, based on the differences, that they value them in different ways. So if you look at how gold is valued, we had a podcast and a YouTube on this. We went through the different ways that gold might be valued. And everyone has their own way. We mentioned consumer sentiment might be one. When consumer sentiment is high, gold might fall because there's no fear in the market. Similarly, or contrarily, silver might rise when the consumer sentiment rises because industry is booming and there's a greater need for silver. It doesn't have to be that way, but you can see there's an example where silver might rise without gold, but generally that's not the case. It could be based on inflation numbers, could be based on dollar strength. This is gold, not so much silver, where interest rates are, whether they're positive interest rates or COMEX is a very, very big one. A lot of people would agree with COMEX. What's the open interest? Geopolitical risks probably impact the price of gold a lot more than they impact the price of silver. Industry demand. Now we see that clearly impacts platinum and palladium. They move, and copper, they move on that. Doesn't seem that silver, even though it is largely an industrial metal, doesn't seem to move higher when we see these increases in demand for different uses of silver. And that brings you back to maybe it's the COMEX pricing that does that. Supply and demand. Now someone mentioned in the comments mining. I would say that mining output probably doesn't impact, or the price of the cost of pulling gold or silver out of the ground versus the current market price. I'm not sure that has much to do with it, at least for gold, because most of the gold that's traded every year and moved around doesn't come from newly mined sources. Most of the newly mined gold every year goes directly to jewelry. But a lot of the gold that you, and then also the central banks that are adding gold, they are taking that from their own mines, like Russia and Kazakhstan, maybe Turkey. But if you shut down gold mining in a particular year, let's say this year, and gold mining's been going up, it's gone up about 30-40% over the last 10 years. But if it were to go back to 5-10 years ago's level, let's say it decreased 25-30%, that wouldn't create any type of shortage. It wouldn't mean that the price would go skyrocketing. Similarly, if the gold mining production costs rose closer to the price of gold, that probably wouldn't drive the price up either, because first of all, the mines don't shut down just because it's close to the cost of production. At least with gold, they don't. There's a couple of mines in South Africa, big mines, they're running at like $2,800-$2,900 an ounce, and they continue to mine because it's expensive to close down a mine. And also, for the most part, most large, I did a look at this, the top 10 gold mining companies all have costs that are still below the $1,180, $1,190 range that we're in. Most of them are under $1,000, and they're not going to stop mining gold just because the price gets close. Now, silver may be a different, at least a primary silver mine will probably shut down, and that may cause, although so far we haven't seen it happen, may cause a current year's deficit in silver mining. But silver mining has gone up the last 20 years, pretty much in a straight line. It's at 850 million ounces, maybe a little bit down this year, but for the most part, the silver mines, even though we've seen over the last couple of years in the price dips, some of the primary silver mines, most of them are pretty small in Mexico. They may mothball some projects, but most of the silver, you have to remember, is not mined by primary silver mines, but it's mined as a byproduct of other mines. A lot of them are gold mines, lead mines, zinc mines, so on. So the silver mining hasn't really shut down yet. But I would agree that because silver probably relies less on stockpiles and more on current year mining, that the supply demand in the mining industry might impact silver far more than gold. So that's another difference. Silver could be driven by the gold price. Central bank buying is an area where it might drive the gold price, although I think the amounts that they buy are not that significant. But clearly, central bank gold buying has got nothing to do with the price of silver. Checking out your imports that are going into India, because what India buys and what China buys, those are the two world's largest gold and silver consumers, so those may drive the price or at least provide a floor. Some people look at ETFs. Now, ETFs are interesting because the gold ETFs, the flows in and out of gold ETFs tend to track the price of gold, whereas the silver does not. The silver has pretty much been going up and increasing in the amount of silver that's being stored in ETFs, and the price is going down. Whereas in the last few months of this year, where gold price is going down, we also see a decrease in the gold held in the ETFs. All right, now we're going to look at what I want to show you. Also, there's the monetary base. Let me show you that one too. When you have a the debt, not the monetary base. Let's take a look at this one. When you have the debt rising, we saw in, you could probably see that now on your screen. We saw when the gold price was rising from 2008 to 2011, 12, and so on, that you can see it on your screen. I'm unable to square that. I don't know why. I'm going to have to walk you through it. But when the price hits the bottom, that is, I got to see it myself. Okay. So the very low, that shows the bottom window, public debt to gold ratio. The most current is 16.8. And that reflects the amount of debt versus the price of gold. And it reached its lowest at about 8 in 2000, and it looks like middle of 2011. And that would be the line to the right side of your screen. And you could see from there it had been all the way as high as in 2000 at 22 to 1. Now that's not because the debt was increasing, it was because the gold price was low. So you had a high ratio of about 22 to 1. But you see back to 1990, on a relative basis, you were back to around 8 to 1. But right now we're at 16 to 1, and you can see as the debt has, look at the top window, public debt, you can see it just keeps going higher and higher to that $21.1 trillion number in a straight line. The gold number from the middle of the chart in the middle panel was going up in price, and then the gold price has come down, even though the public debt was rising, and that led to an increase in your ratio, because it's now 16 to 1. So you can't really say that as we add more debt, the price of gold will rise. We've added more debt and the price fell, and therefore the ratio rose. Silver, there's probably no connection whatsoever to that, other than to the extent that it might track the gold price. All right, now let me just show you something else, that we're talking about a gold decline. And this is going to be very dramatic when we see the massive price swings that you see in the difference between gold and silver. When silver gets hit, it gets hit hard. And you're going to be surprised when I show you over the last 48 years how often silver has fallen and how hard it's fallen versus the relative calm of gold. But this is just showing a comparison between the 1970s bull market decline and the relative decline of the 2000 bull market decline since 2011. The red is the 2011 bull market, the yellow is the 1975 bull market, and they pretty much follow the decline. After they hit their high, they declined. You can see the yellow and then the blue, and then they started to come back up. All right, now let's look at gold in a classic bull market comparison. 1975 bull market versus the 2000 bull market. And there you can see it. Now, at the top you have 1970 to 1974. You don't see much movement until really 1973, because the price of gold was set at $35 until Bretton Woods, and then it starts creeping up. And when the inflation started to hit, then you started seeing in 1973 the price rise. Now, if you look from 73 to middle of 75, the price rose all the way up to a few $100s there. And these are in adjusted terms, because the price only went to $800. But you can see then it fell down. There was a bit of a peak in 1975, went down in 1976, 1977, and then it took off for 77, 78, 79, 80, reaching an inflation-adjusted high of about $2,600. And the current bull market that pretty much looks like it ended in 2011 only went up to, in the terms of the 1970s, to about 800. But the interesting thing about the two bull markets are you're going to see it with silver too, the gains in the 70s bull markets were far greater. And let me show you what I'm talking about with the two bull markets. All right, this is the bull market gains of the 1970s versus the 2000s. The bull market gains for gold were 2,382%. It's massive. Gold price was around $35 and it topped off in the 800 range, whereas the 2000 bull market started around $252 back in 2000, and it got as high as about $1,900, $1,911, and that was a 374% gain. So big gain, but nothing like the 70s. We haven't had that massive inflation, the oil shocks, nothing like that at all. But it was a bull market, and looks like it's probably, could still call it a long-term secular bull market, but we do have those declines, so maybe not. And here's another way of looking at it. Here is the bull market, our current bull market, supposedly, versus the, if you track it back to the early 70s, one could argue that we're not there yet. We haven't reached the same gains yet that were in the period of time of like 1976, 1977, and we've got yet one more big move up. That's how some might look at it, but who knows. Now let's look at gold mining before we get to silver, because gold mining is very interesting, because the gold mining stocks in the 70s did far better than they did in the most recent run-up. You can see that we did not have the same highs in the red line on a comparative basis that we had once the gold bull market took off. You look on your left side of your screen there. Once the bull market took off in yellow, it really took off and went down a bit, and then it really ratcheted higher. We're seeing that the gold mining gains have not been as great for in this run, but that makes sense in a way because the metal prices also increases have not been as great. Now let's go to silver. And silver, this just shows, is an entirely different kettle of fish. So let's look at the last two bull markets in silver. And that would be your 70s bull market versus your 2000 bull market. And I hope you can see it. Okay, so on the top, you have the 70s bull market. And you can see this steady run up and then a big increase, massive increase, major spike, and then it comes right back down within a course of 8 years. And you have something similar, but on a comparative basis, it was nothing like it because they both reached the same nominal high of $50. But you're talking inflation adjustment terms, not even close. Well, let's take a look at another comparison here. So the bull market gains of 1970 in silver were 2,144%. And in the 2000 gains were 179%. So clearly that last silver bull market was monumental, the one that happened in the 70s. Not that this one wasn't big, but it wasn't even close. Here's another way of looking at the bull market in silver. If you want to track it this way and say we're not there yet, but basically, we're in 1977 or so, but not sure you can draw lines and make them match up however you want. But here's the main point I want to show. And a lot of people don't know this. Let's take a look at gold over the last 50 years. And this you're not going to be able to see. I'm going to have to walk you through it. So what I have here, all these charts are Nick Laird. Gold charts are us. Excellent charts. What he's done is he has shown the gold price or the gold increase in price since the early 70s. So he's got 40 years worth of gold going up and gold going down. Now, for gold going up since 1970, this is very telling for those people who think that gold and silver are the same thing. It's not even close. Since 1970, gold has gone up, or has only gone down 18 years out of the last 48 years. We're not counting this year. That means that gold has gone up 62.5% of the time. So if you buy in any given year, you've got a decent chance that it's going to go up. So keep that in mind. 18 years of the last 48, not including this year, the gold price has gone up in those years. The highest gain in any one year for gold was in 1979, and that was 136.2%. It's the biggest gain in gold. So basically, it doubled like time and a half. The lowest, the biggest drop that gold ever had was a 32.8% loss, and that was in 1981. So after you had the big run up in 79.80, then you had a fall off to 32%. And the next closest drop in the last basically 50 years was in 2013 when gold fell 28%. So gold fell 18 times, 18 years out of 48. Its biggest gain is 136%, biggest loss 32%. Gold in 48 years only fell 30% once, and that was that 32.8% year. Gold has never fallen in the last 50 years more than 35%, more than 40%, more than 45%. Biggest loss in gold, 32%, biggest 32%, biggest gain, 136%. But now let's take a look at silver to the extent I can show it to you on the chart, but I can easily walk you through it if you can't see it. And I'll put these on the blog post tomorrow and you'll see them there. And you can follow along there. Now, silver, an entirely different chart. Anyone who's trying to claim that somehow the gold-silver ratio should be at some mythical number. Historically, it's not even close. The two metals don't really even track each other very well. So, silver, in the last 48 years, has fallen in half the years. 24 of the years, silver has been down. Just look at, I'm looking at here. Look at all that red. Silver historically falls a lot more years than gold does. Gold rose 62.5% of the time over the last 48 years. Silver rose half the time it fell. In some years, it consecutively fell. You can see a lot of times where it fell 1, 2, 3, 4, 5 years in a row. 1, 2, 3, 4 years in a row. Happens all the time. Silver has streaks where it can run and run and run and not rise. So 24 of the last 48 years, half the time silver has fallen. But here's where it's even more dramatic. We mentioned that silver rose 62.5% of the time, only fell more than 30% once. Silver has fallen more than 30% 4 times and has fallen more than 40% twice. So silver has fallen, in 1980 fell 44%, in 1981 fell 49%, and then it fell 30% in 1984, it fell 24% in 2008, 36% in 2013. It has a history, and I call it the spike and dive metal. Now let's talk about those spikes though. The biggest gold gain in the last 48 years in 1 year was 136%. Silver in 1979 rose 374%. So again, when silver pops, it pops, and then it dives, because the next year it was down 43.9%, the year after that 48.7%, and then down goes Fraser. Silver's big year in 2010 was 83.7%, followed by 2009 49%, and then we had a 10% loss in 2011, an 8% gain in 2012, and then bam, 2013 36%, 2014 20% down, 2015 12% down. So silver definitely spikes and dives, and not necessarily in a correlation with gold. Gold rose 62.5% of the years, silver only 50%. So it's not just how much does silver go up versus gold. There's not even a correlation. Sometimes gold goes up and silver doesn't. So it's not just that when gold goes up, silver goes up higher. No, sometimes gold goes up and silver doesn't go up at all. And sometimes gold falls a bit, but silver crashes. So they're not necessarily correlated by price. They're not correlated by properties. They're really not the same metal, and they trade extremely different. And to argue against the last 100 or so years that somehow it's 16 to 1 or 9 to 1 or based on relative rarity, it's close to moronic to even think that the ratio is somewhat relevant. All right, let's see what we got in the way of questions here. Buonasera tutti. How does anyone know how much they have, says Bill W. I think he's asking about the JP Morgan vaults, and you don't. That's the point. I think when people want to believe that Russia or JP Morgan has gold or silver, they'll definitely swear by what they see on a chart or what they're told that's in a vault. But then when you try to say the U.S. has a certain amount of gold, no, they don't, because it doesn't fit the narrative they're trying to push that the U.S. has no gold in the vault or it's been hypothecated. So everybody has it. I refuse to insist that the numbers I see for the U.S. Mint, or not the U.S. Mint, for the U.S. gold reserves or the Russian gold reserves or the People's Bank of China gold reserves or the JP Morgan vault or any vault, as Bill W. asked, did they let you in the vault to count it? No. So if I have no real independent verification, either personal, which is never going to happen, but a real trusted audit, then I can dismiss it. But I also won't insist, like many do. When the numbers suit their purpose, they believe them. And when they don't suit their purpose or narrative, then they just toss them aside as, those are just official numbers, they're made up. So I try to be consistent and say, here are the numbers, this is what they say they have. Let's assume for our presentation or argument that these are correct. All right, buonasera tutti. Let's see. Oh yeah, if billions of tons were found and easy to get at, price would fall. He's asking, we were talking about the potential impact on price that mining would have, and that is definitely true. If billions of tons were found, and that's what happened in, it wasn't billions of tons, but during the gold rush of 1849, the price of gold fell, obviously because they found more gold, and actually silver price rose, just that on a relative basis. Excess supply, demand is just what people can afford to buy. Yeah, I'm talking about in the, not in such dramatic circumstances, mate. I'm talking about if gold mining production fell 10% because some mines slowed production, that's not going to have, I don't think, it hasn't had, we haven't seen that have an impact. But yes, clearly, if massive amounts of gold or silver come onto the market, or massive amounts just come off and go away 100%, then that would have an impact. One other example of that would be during the period of exploration in the New World with gold and silver. So much silver went back into Spain that it created, there was all that money going in, the money supply increased, it created an inflation because of all the silver coming back from the New World. So yes, that would happen. And then Bogus Fiat says just wait till they mine asteroids for gold. Well, that would be Elon Musk and SpaceX. I don't know if that will be profitable. I'm sure they say. The one thing is, I don't know how they do it, but if they were able to grab platinum, would be one where they can make it really cheap, because platinum is where it is in a sense because it has some industrial use, a central industrial use, and some jewelry use, but there isn't that much of it. But if they were able to drag an entire meteor back and double the supply, that would have an impact. But I don't know how much it costs to go get the stuff and how far off from they even bothering. They can also, they say they can mine the gold at the bottom of the ocean, which would be very expensive. And there's also, they say, a lot of gold in the water itself, but you just have to sift it out, and that's very expensive. Yes, not easy to get to. And Mate says, it's also the level of wanting the object. Yes, and we did cover that at the beginning about the desirability historically of gold over silver. I don't know how you put a number on it, but your wedding ring is going to be gold. It's just, silver is just not as attractive to most people. Some people prefer silver, but that's just personal taste. But the lore, the folklore, the desirability, the history is gold has always been the golden touch, the gold mine. It's just, Smaulgld has gold. It's not silver. Rappers flash gold. It's just, that's the sign of wealth, not silver. Carl Joseph DeMarco. Combination of many things is made. Absolutely. Do you know if miners would like to have a different pricing mechanism that doesn't force them to sell forward? Well, they might. But you see, that highlights that maybe they don't have pricing power. Think about the OPEC cartel. Now, they're a cartel, and the reason they get away with the cartel and away from U.S. antitrust laws is because they're not U.S. companies. But similarly, I mean, Mexican companies, nothing stopping them if they wanted to form a cartel and price fix and hold back supply. The difference is, first of all, with gold, it's not essential. Meaning, let's say all the gold miners went on strike because for whatever, all over the world, and they just said, we're not going to produce gold. The world wouldn't stop because there's enough gold for whatever essential use that you have for gold. You can find it. I mean, there's 180,000 tons around the world. Price might go up a bit, but you can find it. They wouldn't, if you shut down oil supply, even if you have a country like the U.S. with strategic oil stocks, eventually they run out. We do, like silver is, oil is different in that it is a just-in-time commodity. You can try to store it, but basically you rely on the oil that's being produced at a given moment, given month to supply your needs. Whereas gold, if I told you tomorrow you wanted to buy a gold coin, you'd saved up your money, and now you can't buy it, so what? You can't buy it. If I told you you can't drive your car because there's no oil, that'd be a bigger deal. So the gold miners don't really have that kind of leverage. Silver miners, they might. But the thing about silver miners is they're not silver miners. The most of the silver comes from non-silver miners. So the silver miners would be shooting themselves in the foot if they said, well, we're not going to produce it. Well, the essential silver that would be needed for industry could be satisfied by the gold miners, the lead miners, the zinc miners, the tin miners. So that's why the silver miners don't really have that power, because they're only a small percentage, maybe 30% of the production, and they can't really create that immediate crisis demand. And I would say if they could, they would have done it already, because it's there for the asking. If it made sense for them to do it, they probably would have done it. But I think they've probably talked about it and realized that it wouldn't work. And you know, when you try to pull off a cartel, when you're going to hold back supply, you have to be comfortable that when you're going to be able to recoup your losses from not selling for that period of time in which you're holding back supply. Now, clearly, Saudi Arabia, Russia, all the OPEC nations, they don't have a problem with that. They'll cut back supply. They say, okay, so we'll make less of this. So we even lose money in the next couple of months. We know we'll be able to ratchet it back up because we'll get our price. And we're just going to choke the supply. I don't think they have that pricing power. Carlo Joseph Di Marco in silver. Call that alchemy. I remember gold at 800 in 1980 like it was yesterday. I wasn't paying attention at the time to that. How old is Smaulgld? Someone, I'm not going to tell you, but someone said someone referred someone on, I think it was the Truth Never Told video about the gold silver ratio, and someone said go listen to Smaulgld's take on the ratio, and the guy says, yeah, I listened to it, and he's young and doesn't understand. I said, okay. Then he said, I'm younger than his kids, so I don't know how old he is. We know that silver is more volatile than gold, so those numbers make sense. Clearly, that's right. If you've been following gold since 1980, you know that when silver fell in 1980, it collapsed. It dove into the ground and looked like it was never going to get up again. And it happens a lot. I call it the spike and dive metal. Gold has never fallen 40%, 45%, 49% like that in the last 50 years. Silver did it twice. Silver fell over 30% 4 times. Yes, they can make gold with Hadron Collider. Yes, they can make that type. You actually can do alchemy with gold. American Supertramp had a message, but it's been retracted. I wish I knew what it was. Not me. Sure, we can tell how much they have. We'll just measure it by the mug. I was paying attention. Well, there you go. I could ask a question, but you'd have no way of knowing the answer. But I could take a poll. I don't even know how many. If I were to ask you, how many mugs do I have on hand right now? But I'm not gonna ask that question because I don't know the answer. I'm looking at a number of boxes, but I couldn't tell you. All right, there's going to be a mug shortage. For space mining to be profitable, you need different technologies than you have today. Chemical rocket would be too expensive. They probably haven't released it yet. I just don't know how they get it back. I mean, I suppose it would never make sense to mine silver. I mean, the amount you'd have to bring back at the current price, it wouldn't be worth it. Human body uses small amounts of gold. Yes, there's gold. There's all kinds of precious metals in your body, supposedly. I think you're worth about... I saw some. I don't want to give the number. Whether it was $1.89 or $79, there's value in each person. Of course there is, but I mean in mineral value. Okay, well, I want to thank everyone for listening in tonight. Those charts, I apologize. They didn't come out tonight. You'll be able to see them tomorrow. If you go to smaulgld.com, I'll reproduce all the charts. Or you can consider going over to Nick Laird's Gold Charts or Us and subscribing for a year. I think it's about $180 or $200 a year. I've been on the subscription, because I do my own charts, limited charts. I may keep track where I source the data myself and do the charts. He has thousands of charts, like the ones I just showed you. I don't know how he does it. It's an amazing resource there. So, All right. Well, thank you very much, and we'll see you tomorrow, 8 o'clock Eastern Standard Time on YouTube. But then it's uploaded on YouTube. You can re-listen to it. You can also hear it on BitChute, a Smaulgld channel. You can hear it on real.video. I have a channel there. I post to Gab, Twitter, Facebook, Google+, and Steemit. But the best place to go is Smaulgld, because on Smaulgld.com, you see the charts better. They're there. And you also you can play the video right from the page, either BitChute or YouTube, and then you can scroll the charts yourself. And you can subscribe there. It's free. I don't send out the email every time because I do a nightly podcast. I generally send out 1 to 3 at the most a week of the Smaulgld to the Smaulgld subscribers. And generally, the one that I always send out is the, in case you missed it, top gold and silver stories for the weekend, whatever the week is. And that way you can get caught up. And it's a reminder to go check out the channels as well. All right, and if you're interested in the Smaulgld mug, you can buy your Smaulgld mug at the Smaulgld site. That's it, smaulgld.com. There you go. And you can buy the Smaulgld Classic and Super Classic mugs with free shipping in the United States. And you also get a free Smaulgld Game Changer Eraser with those mugs. Those are only the Classic and the Super Classic mugs. The Smaulgld mug to go and the Smaulgld mug espresso mug are shipped from the manufacturer, so I can't put a note in there. I can't put a eraser in there, but you can check out the Smaulgld products. Very cool products. And also consider becoming a Smaulgld patron. I love my patrons. I got about a dozen of them. They send me a whopping amount of money each and every month that helps pay the hosting fees. Almost, not really, but it's close. It's nice. And also you can donate via PayPal, Bitcoin, or Litecoin. So thank you very much for listening tonight. And please come back again tomorrow. And thank you again for your comments. Always some excellent comments. Makes the show a lot better than just a podcast that's pre-recorded. Thank you very much.